Inflation is here, and it has been causing everything to go up in prices, from food to car prices to properties. Everything has become more and more expensive nowadays. Everything except for your stocks, of course, that has been becoming cheaper nowadays. Some might even say that the real crash is not here yet. So let's answer the million-dollar question. How can I beat inflation and still grow my wealth? More importantly, is now a good time to invest despite all the sky-high inflation and the dip might possibly dip even more? Should I wait for things to, stop crashing before I start investing? In this video, I will address all that and also share how you can beat inflation and save on taxes with MoneyOwl, the sponsor of this video. But more on that later. Throughout our investing journey, we will come across many advice like time in the market beats timing in the market, or the market is a weighing machine over the long term. We hear them so much to the point that this advice actually feels like superstition already. Like, don't point your finger at the moon, later your ear will get cut off kind of superstition. This feels especially true if you had just started investing in these past 2 years, had only bought good stuff like the S&P 500, Apple, and Google, and kept dollar cost averaging like what Warren Buffett always tells you to, and you never sell because you are a long-term investor, not a noob gambler. Chances are your portfolio will still end up being super red, like it's celebrating Chinese New Year or something. Add to the fact that inflation will remain high, interest rates will keep going up, recession will almost certainly happen, the war will get worse, companies may start missing earnings. That's when we will start doubting all the investing advice that we have been hearing. We'll be like, keep holding Sure or not? Market going to jibaboom and crash to zero leh. Maybe I should sell everything, then buy back when things get better? Sure, of course you can do that. But before you click the sell button, let me show you why that might not be a good idea. First, let's talk about how inflation affects the stock market. Most people think that if inflation goes up, stocks go down. And if inflation goes down, stocks go up. So simple. Well, yes, but no. Check out this chart. The blue line is the S&P 500 and the orange dot is the inflation. Here, it shows that when inflation is high, sometimes the market gives super good returns. Other times, it gives a negative return. Meaning, high inflation doesn't always mean that the market will give bad returns. Here's another chart that plots the S&P 500 annual return versus annual inflation rate. The dots are all around the place. Again, there's little correlation between stock market and inflation. But of course, this is oversimplifying a lot of things, like maybe value stocks perform better than growth stocks during high inflation periods, or inflation affects each sector differently. I'm just saying as a whole, there's no clear relation between inflation and the stock market performance. Okay then, maybe inflation doesn't affect the market. Then what about negative events like rising interest rates, or even worse, the war? Check out this chart. We have many scary events every now and then, like World War II, Cuban Missile Crisis, Vietnam War, Black Monday, Asian financial crisis, 9/11, the pandemic, and so on. But guess what? The market be like, this is fine, and just kept going up. Yes, it's true that whenever there's scary news happening, the market will usually give negative returns at the start. But after that, the market has on average recovered within 2 months, with the worst being during the Pearl Harbor attack, where the market took around 10 months to recover. What about rising interest rates then? Again, on average, the market has given positive returns during rate hike cycles, with 70% of the time ending up higher at the end of the rate hike cycle. Now, you might be wondering, why does the market keep going up? How come it can ignore what's going on in the real world? As Benjamin Graham once said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. In the short term, stuff like supply and demand, earnings reports, macroeconomic stuff, market sentiment, interest rates will affect how the market moves. But over the long term, how the market moves is very simple. Has the company made more money or less money? Here, you can see that the orange line, or corporate profits, go up over the long term, and the blue line S&P 500 goes up together with it. Of course, sometimes when there's a lot of greed in the market, the S&P 500 will go up too fast and furious, like what happened around 1997. It becomes too expensive and eventually corrects back down. This is the same right now, where the market has run up quite a bit, but corporate profits haven't gone up much. That's why a crash is happening now. But if you just zoom out, the trend is very clear. Improvements and technological process causes the S&P 500 to go up over the long term. That's why if you are investing over the long term, you will most likely be alright. Then if you are smart enough, you might say, it's easy to say that the market will go up over the long term. But if I buy now, the dip gets deeper and I will lose money. Of course, it's better to wait till things get better before I buy in, right? You are absolutely right. It's always better to buy stocks at a cheaper price. So, here's my question. How would you know when is the best time to buy stocks? Here's a chart of the 2007 market crash. Would you buy here when the market has rallied for 12 days? How about here when it went up for 69 days? Or maybe here after a super big drop? Or here, the drop after the big drop? Okay, maybe it's hard to tell by looking at the charts. How about we start buying when we start hearing good news? Like maybe we wait for inflation to come down, or the war to end, or interest rates to come down? Yes, you can do that, but unfortunately, that doesn't work. Because the market is much faster than you are. If you think this is the best time to buy, too late, the market has already gone back up by then. For example, in 2009, during the Great Financial Crisis, there was maximum fear. The market was crashing super hard at that time. Goldman Sachs was warning that the S&P 500 could fall even more. A report showed that banks still had large exposure if derivatives fell. That's when the market bottomed on March 9. In another study done by JP Morgan, they found that from 2002 to 2021, if you have just stayed fully invested, you would have made the most returns. But if you try to time the market and miss just 10 best days out of the 20-year period, your returns would have dropped by half. Miss 20 best days, your returns will look super sad. Miss 40 best days, you might as well not invest because you have gotten a negative return. What's worse is that 7 of the 10 best days usually happen within 2 weeks of the 10 worst days. Yes, with perfect timing, you will get the highest return. But more often than not, you will time the market wrongly and get lower returns. A better way would be to just dollar cost average, where you will get an average return. So then, what you can invest in? If you are a pro at investing, you can totally choose and pick your stocks. But if you are new at investing or don't have much time to do all the research, you can invest with a robo-advisor. And here's where MoneyOwl comes in useful. MoneyOwl only offers fit-for-purpose solutions that rely on time-tested investment strategies. The good thing about investing with MoneyOwl is that they let you invest your cash as well as SRS funds. Just in case you don't know what is SRS, it's basically a saving scheme that lets you save up for retirement while saving on taxes at the same time. Every year, you can contribute up to $15,300 to SRS. If you are in the 7% tax bracket, by contributing to SRS, you would have saved $1,071 on taxes. But there's a tiny problem. Your money in your SRS account will just earn a super sad 0.05% interest per annum. And inflation will come and eat up your SRS money. That's why it's important to invest your SRS money. Here's where MoneyOwl comes in. MoneyOwl lets you invest your SRS money and grow it over the long term. They have created a selection of well-researched and globally diversified portfolios that you can invest in. They have Dimensional, which invests in broad-based market funds. The special thing about dimensional funds is that they rely on their decades of research, which shows that by tilting or slightly overweighting into equities that have higher value, smaller market cap, and better profitability, the funds are able to deliver higher than expected returns in the long run. There are multiple studies which show that dimensional funds consistently outperform normal index funds. And the best part, the expense ratio for these funds are usually very low. For example, for the Global Core Equity Fund, the ongoing charges is just 0.26%. They also have Wise Income, which invests in global equities, REITs, fixed income, and bonds. Wise Income is specifically designed to provide you with a steady stream of passive income for the long term. With 3 different portfolios, it is a flexible income solution that caters to your changing financial needs. Like grow and invest, balance growth with income and income focus. For Wise Income, take note that you can only invest SRS in the grow and invest portfolio, yeah? But if you are too scared to invest your money now, it's still alright. At the very least, you will need to park your money somewhere that gives some interest. MoneyOwl Wise Saver, a cash management account, lets you do just that. Currently, Wise Saver is giving about 3.14% per annum 5-day moving average as of 14 October. The money is super liquid and you can quickly withdraw your money and get it back within 2 business days. If you want to know more, you can check out my review of MoneyOwl, where I explain in depth how each portfolio works. So, if you are interested in investing your SRS funds with MoneyOwl, you can do so and earn up to $500 worth of fair price e-vouchers. Terms and conditions apply. This promotion runs till 31st December 2022. On top of that, if you sign up with my link down below and use any of the eligible services, you will also receive up to $60 worth of Grab vouchers. In summary, the market may seem super scary now, but believe it or not, this is actually the best time to invest. So rather than wait for a better time to invest, just slowly dollar cost average in. And over the long term, when the market recovers, you'll be super glad that you invested during bad times. Anyway, that's all for this video. Hopefully it helps you out. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.